Right now, the crypto market is sitting on a knife's edge, and what happens next could shock investors around the world. Bitcoin is struggling to hold its ground. Billions of dollars in options are expiring. Governments are moving toward tighter regulation, and behind the scenes, the use of crypto in global crime is drawing unprecedented scrutiny. If you think this is just another quiet week in crypto, think again. The forces shaping the next major move are already in motion. Bitcoin has been trading in a tense range between roughly $66,000 and $70,000 after failing to maintain upward momentum. Analysts warn that if selling pressure continues and macroeconomic conditions remain tight, the price could slide toward the $50,000 level before any sustained recovery. This isn't just speculation. Institutional demand has cooled in recent weeks, and investors are closely watching inflation signals and interest rate expectations. If inflation data softens, liquidity could return to risk assets like crypto. If it doesn't, the pressure could intensify. Adding fuel to the uncertainty is the expiration of approximately $3 billion worth of Bitcoin and Ethereum options contracts. Events like this often trigger sharp price swings because traders rush to hedge positions or close trades. The max pain level, the price where the most options expire worthless, is estimated near $74,000 for Bitcoin and around $2,100 for Ethereum. When prices sit below these levels, market makers may push toward them, creating sudden volatility spikes. For traders and investors alike, this moment is critical, as rapid moves in either direction could define the short-term trend. Beyond price action, regulatory developments in the United States could reshape the crypto landscape. The U.S. Treasury has urged Congress to pass comprehensive crypto regulation legislation this spring, emphasizing the need for clear rules to protect investors and prevent illicit finance. While regulation often triggers fear in the short term, many institutional investors view regulatory clarity as a bullish long-term signal. Clear frameworks reduce uncertainty, encourage compliance, and open the door for broader adoption by traditional financial institutions. Meanwhile, geopolitical tensions are also influencing crypto policy. European officials are considering a full ban on crypto transactions linked to Russia in an effort to prevent sanctions evasion. If implemented, this measure could significantly impact cross-border crypto flows and increase compliance requirements for exchanges and payment providers. Crypto was once praised as borderless and unstoppable, but increasing regulatory oversight shows that governments are learning how to exert influence over digital financial networks. At the same time, global authorities are intensifying their focus on illicit crypto usage. Recent reports highlight a sharp rise in crypto-funded human trafficking networks and other criminal operations, with stablecoins and encrypted messaging platforms enabling fast, anonymous transfers. Law enforcement agencies are now investing heavily in blockchain analytics tools to trace illicit transactions. This growing scrutiny could accelerate stricter compliance rules and know-your-customer enforcement across exchanges worldwide. Market structure developments are also shaping sentiment. Policymakers and financial institutions are exploring frameworks to manage crypto margin exposure and systemic risk. Meanwhile, new blockchain ecosystems continue launching stablecoins and decentralized finance infrastructure, reinforcing the long-term technological expansion of the industry. Yet derivatives markets are showing negative funding rates, a sign that bearish sentiment remains dominant among leveraged traders. Despite the uncertainty, the broader adoption narrative remains intact. Major asset managers, payment networks, and fintech companies continue building crypto infrastructure, signaling long-term confidence in blockchain-based finance. Historically, periods of volatility and regulatory change have preceded major growth phases. What feels like instability today often becomes the foundation for tomorrow's expansion. Still, the immediate outlook hinges on several catalysts: inflation data, interest rate expectations, regulatory progress, and derivatives market positioning will determine whether Bitcoin stabilizes or breaks lower. If Bitcoin falls toward $50,000, it could trigger panic selling among retail investors, but also attract long-term buyers seeking discounted entry points. On the other hand, a rebound fueled by macroeconomic relief or institutional inflows could rapidly restore bullish momentum. Ethereum's position is equally important. As the backbone of decentralized finance and smart contracts, Ethereum's stability influences thousands of projects built on its network. If Ethereum holds above key support levels, confidence in the broader altcoin market may remain intact. If it breaks lower, risk appetite across the crypto ecosystem could weaken. Another crucial factor is liquidity. During previous bull runs, abundant liquidity from central bank stimulus fueled rapid crypto expansion. Today's tighter monetary environment has the opposite effect, reducing speculative capital flows. However, markets are forward-looking. If investors begin anticipating future easing, crypto could surge before policy changes actually occur. Retail sentiment is also shifting. Social media activity, search trends, and exchange inflows suggest cautious optimism rather than euphoric speculation. This is important because sustainable bull markets are often built during periods of skepticism rather than hype. The absence of extreme retail mania may indicate that the market is consolidating rather than peaking. Meanwhile, technological innovation continues beneath the surface. Layer 2 scaling solutions, cross-chain interoperability, and tokenized real-world assets are expanding blockchain utility beyond speculation. Financial institutions are experimenting with tokenized bonds, settlement systems, and programmable money. These developments may not create immediate price spikes, but they strengthen the long-term value proposition of blockchain technology. The contrast between short-term fear and long-term growth defines the current moment. On one side, volatility, regulation, and criminal misuse headlines create uncertainty. On the other, institutional adoption, infrastructure growth, and technological progress point toward continued evolution of the digital asset economy. For investors, this environment demands discipline rather than emotion. Chasing sudden spikes or panic selling during dips often leads to losses. Strategic positioning, risk management, and awareness of macroeconomic signals are more important than ever. Crypto remains one of the most volatile asset classes in the world, but it also continues to offer asymmetric opportunities for those who understand its cycles. As the options expiry shockwaves ripple through the market and policymakers shape the next regulatory era, one truth remains. Crypto is no longer a fringe experiment. It is a global financial force intertwined with economics, politics, and technology. The coming weeks could determine whether the market enters a deeper correction or prepares for its next expansion phase. Volatility is not a sign of failure, it is a sign of transformation. And in the crypto world, transformation often arrives faster and more dramatically than anyone expects.